Good afternoon, everybody. Welcome to my channel. It's me, Millennial Investor 1914. Yes, so if you know, I like to pride myself as being the wingman, and I have all different type of sauce. I got ketchup, I got hot sauce, I got sauce to put on tacos, but most importantly, I am here to help you guys on your investing journey. I make videos on crypto investing, dividend growth investing, how to make money into the stock market, and most importantly, I'm just here to basically, as one of my goals is to hit $100,000, and then once I hit that $100,000, I want to show people in the Black community and just the whole investing community that, hey, that someone like myself can stay consistent and can do it, and that hopefully my videos can inspire individuals to, like, you know what, I can do it. And if you had questions on about what stocks to invest into, or how to do research, or how, for me in my thought process, because I think about making money, I think about investing in stocks daily and budgeting daily. And so hopefully in my videos, whether it's today, tomorrow, 5 years, 10 years from now, someone is able to pinpoint just basically receiving some type of value from my videos and learning how to invest in the long run. Investing is a long term game. You gotta stay consistent, but when you stay consistent, I'm living proof that it grows. So let's talk about it. In these last couple of videos, I talked about dividend growth investing. In my last video I just made, why dividend growth investing is a timeless strategy. I went over I went over just numbers and graphs and annual percentages of dividend aristocrats versus S&P 500. Let's rewind it. Rewind. Let's go over the introduction to dividend growth investing. So like in the course, the last video is more expert level. Like, you know about dividend growth investing, you know about dividend aristocrats. I gave examples of dividend aristocrats, but if you're new to this dividend growth investing, whether it's you still in the beginning phase, or you still investing and you still just only investing to your 401k, I know you're like, ooh, like, what is dividend growth investing? And I hear you talk about it, Cadero, but can you go over it a little bit more? All right. So this is dividend growth investing 101. Comes, everybody sit down. Let's learn about it. So let's do it. Let's do it. Let's dive in, right? So as a dividend growth investor, I'm excited to explain a strategy that has helped many achieve financial independence. So if you understand FIRE, financially independence, retire early. And so what is dividend growth investing? So there are many ways to invest, and investors choose to want to do it. There are 500 and many different companies that raise their dividends each year, 5 years, 10 years, or longer. And dividends are cash payments that a company sends to shareholders. Simple. How does dividend growth investing works? Let's talk about it. In dividend growth investing, the investor, I, or you, identify dividend growth stocks, analyze them to decide which ones to buy, buys and accumulates the best ones, collect the dividends, and decide what to do with them, and manage the portfolio. That's the key point, because in the beginning, as a dividend growth investor, you have to stay consistent. You have to stay disciplined. You have to stay consistent in buying said stock, said ETF, whatever it is, every 2 weeks, every week, every month, whatever the frequency. You stay consistent, and I promise you, yes, the amount that it pays, it starts out small, depending on how much you start out with your investing. So it may start out with you only seeing $1.25 per quarter. You reinvest and you buy more of the stock or said stocks, and then guess what? The payments, it's a snowball. Now it's $5.25, $5.25 per quarter. Then it goes to, you build it up finally, and now it's $10 a quarter. Now that $10 a quarter is $40 per year. Then you stay consistent, and then that's how. Let's talk about it more, right? The dividend growth investing model. You identify stock or said stocks that you want to buy. You analyze it. How I analyze stocks is it's through Fidelity or Seeking Alpha. What else? It's, and there's other websites that I typically use, but we just go with just Seeking Alpha. You buy and own the said stock. You wait a day and a half, day or two for it to clear. Then you go into your said brokerage and choose for the dividend to reinvest within, either reinvest within itself, or you can hold off and not and just have the dividend go to the said brokerage, and you can choose whether you want to either use the dividend to pay your bills, or you can use the dividend to be reinvested into a different stock, and you can choose. Right here, you collect the money, you can manage, and then here's it's the circle of life, and then right here, and as you see with the snowball, if you have it reinvest in itself, it starts out small, but eventually with time, consistency, and discipline, it grows. It starts out small, and if you depend, it all depends on how disciplined you are, and also how much money you make. So if you make a lot of money and you invest a lot of money, you can be able to hit your goals a lot quicker. Or if you got a side business or a second business, a second job, you receive bonuses, all that extra money. If you apply it to your said stocks, you'll be able to see bigger goals and bigger results a lot quickly than if you just only just had one job. So here you go. And this shows right here. It shows the dividend per share and the stock price. So right here, it shows that uh, PepsiCo has increased. So PepsiCo, I think, I know it's a dividend aristocrat. I think is also a dividend king. Dividend king is a particular company that has raised its dividend for 50 plus years. So typically, right here, as seen below, the snack and beverage company Pepsi has tracked the company's dividend higher over time, more than quadrupling since 1999. And typically, over the past years, when a company increases its dividend, the share price increases as well. So that's why a lot of times you see a lot of stories of individuals who invest in these dividend growth stocks and have a lot of these shares that also they typically have a high portfolio, because basically when you reinvest the dividend amongst the shares of the company, it buys more shares, and then along the way the company increases the share price of said stock of the company. And so that's why you'll see many different examples of individuals who've been investing for long periods of time have these ridiculous six-figure portfolios just by a lot of times not even paying attention to the portfolio. Right here, but this background right here says since inception, our portfolios have delivered average annual dividend growth between 7 and 13%. The blue is long term dividend growth. Orange is the top 20 dividends stocks, and then the gray is conservative retirees, and so this is simply dividends. They have their own different portfolios in different groups of uh, a column of just long-term dividend growth stocks, top 20 conservative retirees, and then you can choose, and it shows right here the annual growth. So why do dividends rise over time? I hinted on this, but we can go over it. So why dividends grow over time is because the stock increases the dividend. I, so I didn't talk about that. So these stocks, dividend aristocrats, dividend achievers, and then also dividend kings, these profitable companies like Centos, McDonald's, Pepsi, Coca-Cola, we as consumers consume the products. They make money, and then as they make money, they make so much money that they don't know what to do with the money, and then eventually they give the money back to us as uh, investors, of owners of their said stocks. And then guess what? It's the circle of life. And then guess what? As a company, as they make more money and profit, they either would pay us dividends, increase the dividend, and then also a lot of companies, they were so profitable that they also share buy back their stocks, and then it increases ownership of you of you have within owning that company. Then right here, step 2, step 3 is you reinvest the dividends, and then while you reinvest in uh, the dividends that you received of the shares you bought buy more shares. So then in the beginning, it starts off like little partial shares. Then it builds up, and then the company every year, if it's a profitable company, tend to increase its dividend. And then also, if you stay consistent, you're also buying more shares of the particular stock. And then guess what? It's a domino. And then boom, 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 boom. Portfolio gets bigger, shares increase in amounts, and then also if it's a profitable company, it increases the dividend. Win, win, win. So like this. I don't know what stock this is. Oh, Pepsi. So it says so Pepsi stock increases dividend. Last year or this year increased its dividend by 10%, and you see the slope. And then also I showed you the graph before the share price of Pepsi has increased as well. So right here it says you reinvest the dividend, and if you don't need the dividend right now, it buys more shares. And then right here, this is most importantly. So the orange line shows income growth if the dividends are reinvested back into the stock. The blue line shows the income growth from a 5% increase alone. And so right here, it shows the importance of reinvesting your dividend stock and not taking the payments to buy groceries or buy uh, use it for bills. You can, but when you compound your annual returns on a longer scale, as you see right here, that's why in investing for me, the once you hit 10 years of compounding or 10 years of investing of your shares reinvesting to itself, then you really begin to see the the progress in your portfolios. And then also once you as an investor, once you hit your portfolio hits $100,000, then you're really able to see the true compound interest into work. Before that, a lot of that is you doing a lot of the legwork, and then the compound interest helping along the way. But once your portfolio hits $100,000, and also typically like around year 10 mark, then your portfolio begins to do a lot of the legwork for you, and then it eases in regards to helping you reach your goals of six figures, $300,000 portfolio, $500,000, $1 million portfolio. So let's go real quick. So what's the pros and cons of dividend growth investing? So growing dividends provide a reliable, increasing stream of income. When dividend growth dividends always provide a positive return, even when the stock prices are going down. 3, dividend payments provide a cushion to offset prices decline. So the last several uh, months and weeks when the share price goes down, I'm still receiving that dividend, and it also helps to level set and try to uh, create some type of stability with my dividend stocks, even though the share prices are is going down. And then also the dividend stocks offer a potential for price appreciation in addition to the dividends they pay. You do not have to sell shares to access your company's profits, unlike when you're investing into uh, ETFs and index funds and mutual funds in your 401k. You have to wait for it to appreciate, 10 years, 15 years, whenever you want to retire. And then in order to receive that money, you have to sell those shares, and then you live off of it, which is good. But then once it's all gone and you sell all the shares, guess what? Money's gone. Compared to here, these different dividend stocks, if it's a profitable company, is increases the dividend, continues to pay you, you live off of it, win-win. Dividends are independent from the stock market. Because dividends are independent from the stock market, the investor can ignore investing noise. Yes. And then dividend growth investors being insulated from short-term price noise when the market is a high volatility. You can just know that you invest into high profitable companies, and they still gonna look out for you. Now here are the negatives in dividend growth investing. Dividend growth stocks being traded on the open market are subject to price risk. like right here, invest into Pepsi. It has a low beta, meaning that it's not going to be a company that you invest into that's going to shoot up and that's going to increase your portfolio by 50%, like Nvidia or Amazon or Google, right? A company can freeze and cut its dividend. They don't just, there's stocks that have suspended their dividend, like Disney and AT&T. So it can happen. Outside of the general market downturns, any uh, individual company can suffer price setbacks, no matter what the market is doing. That's my portfolio, down $3,000. Many of the best dividend growth companies have passed their fastest growth stage. Dividends are subject to income tax. Everything you make money on, you have to pay taxes on. And then investors look for quick score in the market are probably going to be dissatisfied with dividend growth strategy. So if individuals who are looking for quick money, a quick score, try to make money within a day, within a week, dividend growth investing is not for you. Dividend growth investing is investing in the long run. This is investing. This is not I forgot that other type of investing where you're just trying to score and buy meme stocks, like I forgot those stocks, whatever. So uh real quick, so here's my dividend growth portfolio. It is 47,000, but I sold into it, and so it was $1,000, and I bought today. I bought QQQ, so it hasn't updated my uh it hasn't updated my Simply Safe Dividends account yet. So this is going to go down. Um, I wanted some more growth, and I figured that having a mortgage REIT right now is not the way to go. And then lastly, I wanted to show you the advantages of having a dividend growth portfolio, uh, in addition to having like a 401k and a growth account, right? So in my right here, I'm at the age of 34. I'll be 35 this year. So just say right here, I have a $47,000 account. I tend to invest between $10,000 to $12,000 per year. My dividend portfolio is 3.54%. I am guessing that my portfolio is going to increase its dividend by 10%, and then it's going to have a price appreciation of about 10%. And so right here, uh, if I invest within let's say 10,000, I'll be in 3 years, in 3.5 years, maybe 4. I'll finally be able to hit that $100,000, and then I can really, like, okay, cool. My portfolio going to hit in overdrive. And for me, I plan on retiring in, I want to say 16 years. So I want to retire at the age of 50. And so right here, it shows right here that I have a portfolio of $700,000, and it'll be paying me roughly $25,000, which is sweet. And then also I will have my house. So in the meantime, hopefully, like, my house will be majority paid off, and then I'll just sell my house. I would just sell my house, and then whatever equity that I have, I would just either dump some of it into realty income, because hey, I've got realty income on my portfolio, and then hopefully my investment in QQQ and applied materials, Apple, those tech stocks would have ballooned and would have appreciated a lot over the past, let's say, even the 10 plus years, right? Even 5 plus years. Now, hopefully with that, it will help into be able to sell some of those low yielding stocks and dump it into more of my high yield stocks to, bump this up from 25,000 to hopefully maybe 30,000, 35,000. Then I could probably go live off of it in Brazil or Colombia or Philippines. So who knows? So just wanted to show you guys just how dividend growth vesting, when you buy, staying consistent, how the annual increase grows. You see right here, right now, I have a portfolio that's paying me about $1,600, and then it with the dividend increases of Starbucks, Microsoft, and reinvesting the dividend, it grows. And right here, I show you it is evident that it can happen. So hopefully you guys really enjoyed the introduction to dividend growth investing and what it's about, and learning what it's about, and basically learning my strategy and what I plan on doing. And hope you guys enjoyed this video. Peace.